good day. For today's discussion, we are going to discuss about cash. Cash is a very common term in today's world. In layman's term, cash means money, and when we say money, we refer to currency and coins which are in circulation and legal tender. However, in accounting parlance, cash connotes more than money. As contemplated in accounting, cash includes money and any other negotiable instrument that is payable in money and acceptable by the bank for deposit and immediate crest. Accordingly, cash includes checks, bank drafts, and money orders because they are acceptable by the bank for deposit and immediate encashment. Thus, to be reported as cash, an item must be unrestricted in use. It must be readily available in the payment of current obligations and not be subject to any restrictions, contractual or otherwise. Cash items included in cash are cash on hand, cash in bank, and cash fund. For further clarifications as to what they mean, let's briefly discuss each item. First is cash on hand. Cash on hand includes undeposited cash collections and cash items awaiting deposit. Some common examples of cash on hand are currencies and coins, customers' checks, cashiers' or managers' checks, travelers' checks, bank drafts, and money order. Second is cash in bank. Cash in bank includes deposits, which are unrestricted as to withdrawal, such as demand deposit, checking account, and savings account. And lastly are the cash funds, which refers to funds set aside for current purposes, such as petty cash fund, payroll fund, and dividend fund. However, be careful and notice if it is for current purpose because cash funds don't automatically form part of cash. How? Take note of the following. There are two classifications of cash fund, and that is current and non-current, which is parallel to the classification of the related liability. For better understanding, let's illustrate it. For example, a sinking fund that is set aside to pay a bond payable shall be classified as current asset when the bond payable is already due within 1 year after the end of reporting period. However, a cash fund set aside for the acquisition of an incurrent asset should be classified as an incurrent, regardless of the year of disbursement. Thus, if the cash fund is set aside for use in current operations or for the payment of current obligation, it is a current asset. Hence, it is included as part of cash and cash equivalents. On the other hand, if the cash fund is set aside for an incurrent purpose or payment of an incurrent obligation, it is shown as long-term investment. Now that you know what cash is and its composition, let us now proceed with the measurement of cash. Cash is initially measured at face amount or face value. The face value of cash refers to value of the coin, stamp, or paper money as printed on the coin, stamp, or bill itself by the issuing authority. However, take note that cash denominated in foreign currency is measured at the current exchange rate at the reporting date, while cash maintained in a bank or financial institution undergoing bankruptcy or financial difficulty is excluded from cash and presented as receivable. In addition to this, let's dwell on the different terms and learn how they work. First is bank overdraft. Bank overdraft is a negative balance of cash in bank account, and it usually results from overpayment of checks in excess of the amount of deposit. As contemplated in accounting, checking accounts may be maintained in the same banks or in different banks. Thus, when two or more bank accounts are maintained in the same bank, an account that has a negative balance may be offset or deducted from the other bank account with a positive balance, provided that the other bank account is also unrestricted as to withdrawal. On the other hand, if two or more bank accounts are maintained in different banks, a negative balance from Bank A is not permitted to be offset or deducted to Bank B with a positive balance. Thus, the overdraft becomes payable on demand and should be presented as current liabilities. Next is deposit in foreign banks. Deposit in foreign banks literally refers to those deposits in foreign banks. Thus, unrestricted deposits in foreign banks that are available for immediate withdrawal are included as cash, while deposits in foreign banks, which are restricted as to its withdrawal, are excluded from cash and presented as receivables subject to appropriate allowances for uncollectability and impairment. The classification of restricted deposit as current and incurrent depends on the nature of the restriction. In accounting per se, if the problem is silent, the deposit in foreign bank is included in cash. Another is compensating balance. Take note that compensating balance is different from maintaining balance because compensating balance is the minimum amount that must be maintained in an entity's bank account as support for funds borrowed from the bank. Thus, compensating balances that are legally restricted as to withdrawal by the borrower are excluded from cash, while if it is not legally restricted as to withdrawal, it is included in cash. The presentation of compensating balance in the statement of financial position depends on the nature of the restriction. If the compensating balance is in relation to a short-term borrowing, then it is shown as part of current asset, while if it is in relation to a long-term borrowing, then it is shown as part of an incurrent asset. Another term is unused credit line, which refers to the difference between the amount of line of credit and the amount that was actually borrowed. Unused credit line is not included as cash, but rather disclosed only in the notes. Another is post-dated checks. Take note that post-dated checks received by an entity do not qualify as cash because post-dated checks are not presently available for immediate use. Also, undelivered and released checks, which refers to one of the merely drawn and recorded, but not given to the payee before the end of the reporting period. It means that there's no payment when the check is pending delivery to the payee at the end of reporting period, and it is still subject to the entity's control and may be canceled anytime before delivery at the discretion of the entity. And finally, stale checks. Stale checks refers to checks delivered to payees that are not encashed within a relatively long period of time, normally 6 months or more. Take note that stale checks are reverted back to cash. To make it easier, remember the following concepts. Post-dated check received from customer are excluded from cash, while post-dated check drawn are included in cash. More so, undelivered check drawn and stale checks are included in cash. Cash is the lifeblood of the business. Thus, a company has to generate adequate cash from its business in order to survive. However, inherent risk is normally higher for cash compared to other assets because cash is exposed more to risk of theft and other types of fraud. Thus, adequate and effective internal controls should be in place to ensure that cash is reasonably safeguarded. Taking as an example, there are different types of concealment of cash shortages, such as lapping, kiting, and window dressing. Let us first discuss what is lapping. Lapping occurs when collection of receivables from one customer is misappropriated and then concealed by applying collection from another customer. This concealment is made possible when the incompatible duties of recording and cash custody are combined, or when there is delay in recording. Let's illustrate how lapping takes place. Merv Company has receivables of $10,000 from customer I, $20,000 from customer B, and $15,000 from customer C. On December 29, the cashier collected an amount $10,000 from customer I. However, she decided to put the money in her purse and spends all money shopping in a mall. On the other day, the same cashier collected an amount of $20,000 from customer B. In recording the transaction, she applied the collection of $10,000 from customer B to the account of customer I to conceal the money she put in her purse. In effect, the initial discrepancy in customer A's account is transferred to customer B's account, and the discrepancy in customer B's account will afterwards be transferred once again to another account when another customer pays. You might be wondering how could the concealment under this scenario may be discovered by the company. Well, An auditor of the company may apply various audit procedures, which may include analytical procedures and confirmation using proper sampling techniques. For example, if the auditor confirms the accounts based on the record, then customer B will dispute that he had already made a payment and must no longer have any obligation to pay the company. This leads to detection of lapping. Another example of concealment of cash shortages is kiting. Kiting is when cash shortage is concealed by overstating the balance of cash. It is made possible by exploiting the float period. The float period refers to the time it takes for a check to clear at the bank where it was drawn. Kiting normally occurs at holidays and bank cutoffs when a check is written to transfer funds from one bank account to another bank account where the misappropriation was made. However, by increasing the balance from one bank account and not decreasing the balance of other bank account, the cash shortage is concealed. Taking as an example, XYZ company has different accounts in various banks such as Bank 1, Bank 2, and Bank 3. On December 27th, the bookkeeper of the company withdraws 500,000 pesos check from Bank 1 account for herself and spends all the money in buying luxurious bags and shoes in the mall. On December 31st, she is afraid that the auditor may detect the fraud she made. Thus, she draws a check of 500,000 pesos from Bank 2 account and deposits it to the Bank 1 account to conceal the shortage. From the given scenario, kiting is done by recording only the receipt portion of the fund transfer but not the disbursement portion. In effect, cash is overstated in order to conceal the shortage. You might be asking, how could kiting possibly be detected? Well, the following may be considered. First is to prepare a bank transfer schedule, which shows the states of all transfers of cash among the various bank accounts. Secondly, is to obtain a cut-off bank statement to verify reconciling items. And lastly, is to prepare a proof of cash. Proof of cash is an expanded bank reconciliation that includes proof of cash receipts and cash disbursements. Last example of concealment is window dressing. Window dressing is a form of fraudulent financial reporting and is not primarily a method of concealing cash shortages. Window dressing is also called as cooking the books. It takes place when transactions in the subsequent period are deliberately recorded in the current period to improve financial performance or financial ratios. In effect, it overstates the collections and profitability of the company. For example, the sales of a company in the subsequent period are recorded in the current period sales in order to improve the current period's profit and to increase management bonuses that are based on sales. That's all for today. See you in our next accounting lecture.